Welcome back to Smart Stock Sam, the channel where we cut through Wall Street noise and hand you the real story behind the stocks that matter most. I'm Sam, and today we are going absolutely nuclear on one of the most misunderstood fintech stocks in the entire market right now, SoFi Technologies, ticker SOFI. Here is what today is really about. Wall Street wants you to panic. They want you to see that brutal single-day drop, absorb those terrifying headlines, and hit the sell button without pausing to think for even 1 second. But what if I told you that underneath all of that fear, underneath the flashing red screens and the bearish analyst downgrades, there is a company sitting on 10 consecutive profitable quarters, a balance sheet that most regional banks would be genuinely embarrassed not to have, and a short interest coiled spring representing 173 million shares that could snap violently upward at any moment. And what if the biggest institutional money on the planet, not the retail crowd, but the giants, are quietly and aggressively loading up their positions while everyone else is sprinting for the exit? That is exactly what we are breaking down today. We are walking through the fundamentals, the macro forces, ripping this stock in 2 directions: the technical picture, the options mechanics, and the exact trade parameters for the week ahead. Stay locked in because the details in this one genuinely change the picture entirely. Look right here at the Q1 2026 Fundamental Health Dashboard. These are not the numbers of a struggling fintech startup that is still trying to figure out its business model. These are the numbers of a financial machine quietly taking over market share at a breathtaking pace. SoFi just reported adjusted net revenue of $1.10 billion, a staggering 42.6% increase year over year. They are not burning cash to acquire users anymore. They are actually keeping the money. Net income came in at $166.7 million, netting 12 cents per share. But the number that truly tells you whether a bank survives when the economy gets rough is the liquidity number. SoFi is sitting on a fortress of $3.4 billion in cash and over $40 billion in deposits. To put that in perspective, their total long-term debt is only hovering between $1.8 and $1.9 billion. Incredibly low leverage relative to that massive asset base. In the banking world, deposits are the lifeblood. They give you the cheap capital needed to fund loans and drive your margins wider and wider. SoFi has not just survived the current environment, they have fundamentally secured their foundation in a way that demands respect. But here is the real question serious investors have to ask. Does one great quarter actually make you a market leader? Because for most companies, the honest answer is no. To see how SoFi is actually separating themselves from the competition, we have to look at one very specific benchmark. And the number they post here absolutely obliterates the narrative that this is just another middling fintech going through a hot streak. In the software and fintech world, there is a golden standard known as the Rule of 40. The concept is brutally simple. Take your top-line revenue growth percentage, add your profit margin percentage, and if that combined number hits 40 or higher, you are considered a genuinely elite company. Most companies in this space are grinding and sacrificing to hit 40. They are forced to choose between scaling fast and losing money or slowing growth to capture profitability. SoFi is somehow managing to do both at the exact same time. Revenue growth greater than 40%, combined with an adjusted EBITDA margin that has expanded to 31%, puts SoFi's Rule of 40 score at a staggering 72%. Not just elite, that puts them in genuinely rare company across the entire fintech landscape. This is precisely why Wall Street has such a hard time categorizing this stock. The old playbook says a company growing this fast should be bleeding cash. SoFi simply refuses to follow that script. And the picture gets even more compelling when you look at what they are actually constructing behind the scenes. Because SoFi is not resting on their core banking app to drive these numbers. They are building an infrastructure moat that could take competitors years to meaningfully replicate. First, SoFiUSD, and this is genuinely massive news that did not get nearly enough attention in the financial media. They launched a fully backed stablecoin issued directly by their OCC-regulated national bank, positioning themselves to capture high-margin on-chain payment fees and tokenized deposits in a market that is still in its absolute early innings. Then, they integrated artificial intelligence directly into the consumer experience with SoFi Coach, an AI-powered financial advisory platform built specifically to deepen member engagement and keep users locked inside their ecosystem. The longer a user stays, the more products they use, and the higher that lifetime customer value climbs. And on top of all the building, they are also buying. Peach Finance Incorporated acquired in May 2026 for strategic integration, plus strategic technology assets from Primary Bid Limited. Piece by piece, they are assembling an absolute powerhouse. And here is the question worth sitting with. Once a customer is fully embedded inside an ecosystem this comprehensive, what are the realistic chances they ever actually leave? Now, none of this matters if we are not completely honest about the risks, because there is one specific elephant in the room that long-term investors absolutely cannot ignore, and this is the hidden multi-billion-dollar metric that fundamentally changes the picture depending entirely on your time horizon. You have to decide right now what kind of investor you are, because the metrics you need to watch are completely divergent depending on your answer. If you are a long-term investor, here is the number that must sit permanently at the top of your watch list. SoFi currently carries an operating cash flow burn of roughly $2.3 billion. Yes, billion with a capital B. Despite that celebrated 10-quarter GAAP profitability streak, they are burning significant cash because of aggressive loan book expansion. Long-term, you must track how effectively their SoFiUSD platform and Galileo technology infrastructure drive high-margin recurring revenue to offset that burn and justify the premium multiples the stock currently commands. If those platforms underperform, gravity will do exactly what gravity always does. But if you are a short-term swing trader, you do not care about the loan book today. You are watching the $15 to $16 support band holding on shrinking volume and whether the VIX index starts retreating back toward the mid-teens, because that movement signals the macro-driven panic is finally exhausting itself. So what actually caused this panic in the first place? Because this is the part that most retail investors completely missed. Over the last few weeks, this stock has been violently jerked around by two massive and conflicting catalysts. In May, SoFi went on an absolute tear, a plus 17% multi-day rally as the market celebrated the SoFiUSD stablecoin launch, cheered for SoFi Coach, and rewarded that 10th straight profitable quarter. Everything was green. Then June arrived and dropped a wrecking ball directly on the chart. In a single trading day, the stock suffered a 6.53% drop, closing at $16.03. Was this SoFi's fault? Not even remotely. A blisteringly hot U.S. jobs report showing 172,000 jobs added in May completely obliterated any hope of a near-term rate cut, pushed the 10-year Treasury yield above 4.5%, and spiked the VIX volatility index to $19.15, a massive 24% intraday surge. Institutional traders immediately began taking profits and fading the crypto product pop from May. SoFi got caught directly in that crossfire, not because anything broke inside the company, but because macro fear simply does not discriminate. Which brings us to the valuation reality check, and this is where you need to hold two very different truths at the exact same time without letting one cancel out the other. SoFi is trading at genuinely premium multiples right now, a trailing price-to-earnings ratio between 36 times and 41 times, and a price-to-sales ratio between 5.2 times and 5.9 times. Strict quantitative intrinsic value models, the kind that strip away all the sentiment and just look at the cold, hard numbers, place fair value somewhere between $12.38 and $14 flat, flagging the stock as approximately 19% overvalued at current prices. When a stock trades at this kind of stretched premium, the market demands absolute perfection on every single earnings call without exception. One miss, one weak guidance revision, one unexpected charge, and the premium can collapse extraordinarily fast, leaving investors who bought the story holding a very painful bag. And when you have a stock that is fundamentally exceptional but quantitatively expensive, Wall Street divides sharply. And the analyst spectrum here is one of the widest I have seen. The consensus sits at a hold with an average price target of $22.56. But the spread underneath that average is jaw-dropping. On the bearish end, Truist lowered their target to $17, and Barclays dropped to $18 equal weight, both anchoring near that June 5th close of $16.03. Meanwhile, Citizens JMP upgraded to outperform with a $30 target, and JP Morgan upgraded to overweight with a $31 target, nearly double current trading levels. That gap from 17 to 31 tells you exactly one thing. Analysts genuinely cannot agree on whether to value SoFi as a traditional bank or as an explosive technology company, and until that debate resolves, this stock will keep swinging violently on every meaningful catalyst. But analysts talk. What actually matters is where the real institutional money is flowing, and when you follow that money, the picture becomes very compelling very fast. Major institutions currently hold 38.43% of the total float, and they are buying the dip. Norges Bank just established a brand new $321.5 million stake, owning over 1% of the entire company. Vanguard, State Street, Legal & General, and Geode Capital have all significantly increased their holdings. Over the last 90 days, insiders did sell 124,479 shares, primarily from the CTO and EVP under prearranged trading plans, standard and not a red flag in isolation. But here is the single most important data point on this entire screen. CEO Anthony Noto is buying aggressively with his own personal capital. He purchased 28,900 shares at $17.32, then stepped back in to buy another 15,545 shares at exactly $16 flat. When the person running the company is dropping millions of their own dollars to buy the dip at these exact levels, that is not a public relations gesture. That is a conviction bet. From a purely technical standpoint, however, the current setup is still flashing a strong sell signal, and we need to respect it fully. The stock is trading below both its 50-day simple moving average, around $16.72 to $17.28, and its 200-day simple moving average sitting further above. When a stock breaks below both averages simultaneously, algorithms and momentum traders hit the sell button mechanically and relentlessly. It is systematic, and it does not stop until it stops. The 14-day RSI sits at 34.68, right at the edge of oversold territory. The MACD sits at negative 0.39, confirming downward momentum, but critically starting to hint at seller exhaustion. The weak hands appear to have already left the building. And when weak hands exit in that kind of volume, it creates a very specific and explosive market dynamic. SoFi has become a coiled spring. 13.70% of the float is sold short, roughly 173 million shares borrowed and sold, with a days-to-cover ratio of 2.42. The dark pool off-exchange short volume ratio sits at 47.21%, indicating massive hidden institutional shorting happening away from the lit exchanges entirely. The setup this creates: if the $15.50 to $16 support holds and macro headwinds even slightly subside, those short sellers must buy back 173 million shares to close their positions. Can you picture what 173 million shares of forced buying does to a price that is already sitting in oversold territory? That is the coiled spring, and the options market is positioning for it to snap. On June 5th, even as the stock was actively falling, total daily options volume hit nearly 531,000 contracts, and 71.68% of that was calls. The big money was buying the dip through derivatives, building massive open interest walls that act as magnetic price targets. The immediate magnet sits at the $16.50 strike with over 10,000 contracts in volume and 8,683 in open interest. The secondary target sits at the $17 strike with over 14,500 volume and nearly 11,000 contracts of open interest. Market makers who sold those calls must hedge their exposure by buying shares as the price climbs, and that mechanically forces the stock toward those exact strike levels. Here is the exact trade setup for the week of June 8th through the 12th. Entry zone: $15.70 to $16.05. Heavy intraday consolidation in this range confirms buyers actively building a base. Hard stop loss: $14.95. If it breaks the psychological $15 level, mid-May, support is gone and a cascade of automated retail stop losses follows. Do not hold the bag below $14.95. That is the trapdoor, and the trade is dead. Target 1, $16.50, aligned with the first major call open interest wall. Target 2, $17 flat to $17.28, lining up with both the 50-day moving average and the second massive open interest concentration. The levels are defined, and the risk to reward is as engineered as it gets. Here is the bottom line. SoFi Technologies is not a broken company. It is a fundamentally sound, profitability-proven, infrastructure-building fintech powerhouse that got blindsided by a macro environment it had zero control over. 10 consecutive profitable quarters, a 72% Rule of 40 score, 42.6% revenue growth, a CEO buying millions of his own dollars at these exact prices while institutions accumulate quietly around him, and 173 million shorted shares sitting beneath the surface, waiting to be covered. The macro panic is real, the technical damage is real, the cash burn risk is real, but the business is not broken, and the setup is not broken. What is broken is the narrative being pushed at you to make you sell before the spring snaps. Before the final wrap, and this is important, nothing in this video constitutes financial advice of any kind. I am not a licensed financial advisor or investment professional. Everything covered here is strictly for educational and informational purposes only. Always conduct your own thorough research, consult a qualified financial professional before making any investment decisions, and never risk capital you cannot afford to lose completely. Investing and trading in markets carries real risk and real losses, and that reality deserves your full respect. Now here is the question I want you to answer in the comments right now. With everything we just walked through, the fundamentals, the coiled short interest spring, the overwhelming call options flow, the CEO buying his own stock at $16 flat, do you personally think SoFi breaks above $17 before June 12th, or does macro pressure force one more leg down first? Drop your full analysis below. I read every single comment, and I genuinely want to see how you are thinking about this setup. If this breakdown gave you a real edge today, hit that like button right now. It directly helps this channel reach more traders and investors who need this kind of deep analysis every single week. Subscribe if you are not already part of the Smart Stock Sam family, because this is exactly what we do here, every week, without compromise. And if this channel has ever helped you spot a trade, understand a setup, or avoid a costly mistake, please consider hitting the super thanks button below. Your direct support funds the research and the hours that go into building each one of these breakdowns, and it genuinely means everything to this channel. Finally, and I am incredibly excited about this, I have officially launched the exclusive Smart Stock Sam membership community, a private space where we go deeper on setups, share deep dive analysis on request, and genuinely level up together as traders and investors. The link is right in the description below. Come join us, because the best trades are always made with the best information, and that community is where the real conversation happens. Stay smart, manage your risk hard, and I will see you in the next one.